Hi, everyone. Welcome to another episode of the LATAM Stocks Podcast. I'm your host, Patrick Flood. Today, I'm speaking with Garrett Goggin. Garrett's an investor and an analyst. He runs the popular Golden Portfolio investment newsletter, which is focused on precious metals and precious metals mining stocks. So today, that's what we're going to talk about. I'm going to ask him about his macro views on the commodities, gold and silver, and then we're going to get into some of the Latin American focused mining stocks that trade in the US or Canada. So most listeners should have access to them. So I followed Garrett for a while on Twitter, and I've learned a lot about precious metals investing and the mining stocks from him. So I'm really excited to speak with him today. So let's do it. Hi, Garrett. How are you?
Hey Patrick, how you doing? Thanks for getting me on here. It's fun talking about
Yeah.
this stuff.
Yeah, I learn a lot from your account, genuinely, and I'm excited to get to pick your brain a bit and talk about some of the mining stocks in Latin America because there's a ton of them and they don't get that much coverage.
Yeah, that's correct. I agree with you.
So let's talk about your background a bit then before we get into the market stuff. So where are you from originally? What'd you study? And then how did you end up focusing on mining stocks?
Yeah, sure. Boston, traditional financial services, worked for a mutual fund company, and it was just, invest for the long term. Everything's going to be okay. I've always been more interested in alternative assets. So, I ended up getting my MBA. I got my CFA, I got my CMT, and then I was able to join up with legend in the industry, John Duty of Gold Stock Analyst. And, that's primarily where, I learned a lot about, the gold miner research and silver miner research. And then we got bought up by Stansberry a few years ago, and now I've chosen to go independent just recently this year.
Yeah, I saw that with the Golden Portfolio. So do you have a geology background at all? Because I'm curious, because
No, yeah, correct. I pick it up along the way, going to mine trips, because the geologists can't really crunch numbers, whereas we can as financial guys. Although, when you build your economic analysis, there's always a little nuance in there regarding grade and recoveries and stuff. So to have a geology familiarity with geology, it helps a tremendous amount.
okay, interesting. So tell me a bit more about the Golden Portfolio. Then you launched it. Who are the clients? How's it been
Yeah,
going?
sure. It's been going great. I have two products. The GP, the Gold Portfolio, focuses on IPMs, inflation protection machines. It's basically the royalties. The royalties have fixed costs. They have an inherent advantage in the industry. People are out there complaining. It's like, oh, Newmont never moves, Barrick never moves. Yeah, because what happens is when inflation picks up, it pushes gold higher, and what else it does is pushes the mining costs up higher. So the majors costs, they never change. They trade at a margin right now. It's increased a little bit of about 55%, but the margins trade between like 40 and 60%, depending on what gold does, but depending on what costs do. And their costs are never going down. So, the gold portfolio focus on the royalties. The royalties are fixed costs. They lock in contracts, and they're all using NAV, 10-year life of mine. They have inherent upside because their costs are locked in at the current gold price. When the gold price increases over the next few years, that is straight profits. And also they get all the free exploration upside, right? When you get a miner and you invest a few hundred mil to help them build it for a 1%, 2% NSR, and then they extend the life of mine through exploration success, royalties get all that for free. You look at Franco-Nevada that paid $2 million for their NSR and Gold Strike. Gold Strike's returned like $1 billion to Franco so far, and they have another 500 mil to go, just based off that initial $2 million payment. And all the royalty companies need is one project, to get lucky out of their vast portfolio. They have portfolios of 100, 200 NSRs. Mining companies have one mine, two mines, three mines. If one of them blows up, they're screwed. Take a look at the big First Quantum, when Panama sees Cobre Panama. It's game over for First Quantum, basically. So the royalties offer a much better risk reward situation. And, I cover that industry very, very closely. The second product I have is the GP10X, which are smaller explorers, developers, and miners, smaller cap stuff, because the way values generated in the mine industry, it's through exploration. Like you've seen good drill holes, right? All of a sudden stock goes crazy. Hundreds of millions of value is created overnight. And that's what I'm searching for. And the thing most highly correlated to good drilling results is grade. You got to follow grade. Grade is profits because The mining costs on a per ton basis is relatively constant. If it's an open pit mine, it's like $25 an ounce. An underground mine, it's like $250 an ounce. But so your costs are relatively fixed. The only way you can boost profits is by increasing your top line production. And the only way you can do that is by grade, by having the grade. So you want more ore in your grade. It's a simple explanation and process, but it's extremely important to the mine industry. You're on Twitter, I'm on Twitter. You see a lot of people out there, they're recommending like these low grade cow pastures. And, even when gold increases, these low grade cow pastures are going to remain unprofitable at $5,000 gold. Why? Because when gold goes higher, their costs are going to go higher. And the majority of these companies, what they do, they dilute, they mine shareholders, they don't mine gold and silver. That's what they're focused upon. So I prefer the ones with higher grade. I follow the drill results very, very closely. I've just added a couple that are very, very exciting that I'm really amped for over the next year or so. And then the higher grade deposits, a lot of them get acquired by the majors. So basically two products right now. Yeah, GP and GP10X.
Okay, cool. So that's a perfect lead in because I have a few questions for you about portfolio construction for a precious metals mining stock portfolio. So how diversified should the average, retail investor be in this industry? Like how many royalty names should the average investor need? How many exploration names? I mean, because obviously you can't bet on one. You can't bet on one.
Talking about the average investor that wants exposure to gold.
Yeah. Maybe not an institutional investor that's going to be paying, but for an average person that knows it's a financial advisor that wants to recommend to clients 5% in precious metal mining stocks.
Yeah, I tell you what, very simply, you throw up the major gold companies, Barrick, Newmont, Agnico. Agnico's done pretty well, actually, Kinross, and the rest of them, IM Gold and Pan American, and you plot them against the gold price, 97% underperform the price of gold. So, bottom line, if you're conservative, one of the best ways to play it is by owning straight gold. However, if you plot the royalties against gold, almost every royalty beats gold by hundreds and hundreds of percent over the past, 5, 10, 20 years. So, you need to look at the larger cap royalties, Franco, Wheaton, Osisko royalties.
Is one royalty name enough then, since some of these have 200, 300 projects in the portfolio? Is one royalty name diversified enough?
Yeah, I would think so. And you know what? There's a royalty company called Triple Flag, and there's this dude in New York, Paul Singer. He runs Elliott Management. They have billions. He's a traditional financial manager, but he likes gold. And he knows the best way to play gold is through royalties. So he hired the COO from Barrick, who just actually left Triple Flag, but he ran Triple Flag for years. And Paul Singer invested $1 billion into this company to get this going because he wants this as his gold exposure. Ideally, that's a brilliant move. That's the smartest move I've ever seen. But you know what? Within the royalty industry, what I've seen happen is you got a lot of smaller royalties out there also, right? And they have a few different properties that they own. When those properties get lucky with high grade exploration, they all get snapped up by the major royalty companies. We've seen massive consolidation within the royalty industry over the past 5 to 10 years. Maverick Royalties, Nomad. One of my favorites was Abitibi Royalties. They've all been acquired over the past few years. And there's a smaller royalty company out there. So what I'm saying is that stay focused on one large cap royalty, but the real bang for your buck comes from the smaller cap royalties. And Origin royalties?
I've seen you post about it. That's where I know the name from.
Here's the deal with Origin. They spent $100,000 in total for this property called Expanded Silicon in Nevada. And AngloGold has been exploring it. AngloGold just released a resource with 12 million ounces of gold. They reported a preliminary economic assessment that shows 1.8 million gold ounce production in year 2 of this Expanded Silicon project. It's worth I don't know, I forget off the top of my head. It's $40 million to Origin. Origin basically, they converted $100,000 into 100,000 ounces of gold. like 1 gold ounce per dollar spent. It's ridiculous. And they did the same thing at Ermitano, that First Majestic owns, that they're filling the mill at Santa Elena, the higher grade ore. And they Origin spent $100,000 developing and exploring a little bit around Ermitano. They're getting like $7 million a year free cash flow from this property. And you look at it on a NAV basis, right? It's like 60 million, worth 60 mil, but then the royalty multiples trade at 20x. So, boom, there's $120 million of wealth creation right there. So, I see this a lot across the smaller royalties. That's what I find interesting. Just, it's all based off profits. You need to generate shareholder value.
Is there still room for more royalty company startups then? You mentioned the Elliott Management seeding $1 billion.
Yeah.
Because it seems like it's kind of still a new model, right? Like Franco-Nevada kind of pioneered it 30 whatever years ago.
Yeah, well, first Franco-Nevada started. They ended up going private. Now they went public again back in 2008. But Wheaton's been doing it with a streaming model for a while. But they all have different little niches within the industry. Franco and Wheaton Precious go after the big boys. Now they're going after a little bit of copper. They want to spend hundreds of millions of dollars. But the smaller guys, there's some smaller royalties that were based in Nevada. Ely Gold, that specialize in all the Nevada projects. So they have a real grasp of the geology and the projects and what to invest in. And they were acquired a few years ago. You get EMX, which is in that Nevada region. But basically what I'm saying is that they all have different specialties. Origin is a prospect generator. They got geologists scouring the ground looking for prospective properties, and they hit it big a couple times. And then there's one, what is it, Vox Royalty that started a few years ago. And some of these are younger guys, and it's data driven. They have huge databases of all the royalties out there. They actually acquired a royalty from a beer company. They acquired another one from a car manufacturing business. So they all have their own specific niches. And then, I haven't seen any royalty companies, in Latin America or in Mexico. I know some of the ones out of Canada specialize in Mexico, but Latin America, because a lot of these royalties are they're private. It's like some old guy owned the land, and he died, so the granddaughter has it, and they're really hard to track and stuff. But they've never really been bundled up, down south, except for the big boys.
Okay, and then what about within a mining or an exploration or junior portfolio? I mean, how many names do you think is sufficient diversification within a portfolio?
More regarding that, like, so whatever, pick a big royalty, pick a smaller royalty, but owning the majors, I don't know. I don't see any value creation. There's a reason why smart investors have avoided this sector, because they're extremely capital intensive. I've seen miners spend $2 billion, spend $1 billion to buy it, spend, 500 mil to build it. They don't get that back, over the life of mine. And so therefore you're destroying shareholder wealth. So to be honest with you, I'd avoid, the larger cap gold mining companies. And, I'd start looking at the smaller cap ones, the explorers and developers, which is the GP10X. Like a lot of smart dudes up in Boston, Seth Klarman, that runs Baupost Group. Yeah. They want a little bit of gold exposure just in case everything blows up, whatever, just to be diversified. But the way that they do it is through exploration sector. They'll buy one or two companies, like a decent stake, and they'll hold that. And it is like a option to them, with basically no expiration. That they'll hold just in case the price of gold goes to the moon, in which case this exploration company will go up, whatever, 10x, 20x, 30x.
And they'll buy something with some proven geology. They know there's ounces in the ground, and they can just let them sit in the ground for the cycle.
Yeah, no doubt. And, like I say, it represents an option with no expiration. But what you do get from the exploration companies is dilution. And dilution is a cancer in the mining industry, and it never stops. And those low-grade miners that never operate profitably or don't have a profitable, they just dilute all day in, day out. And you know what happens when the price of gold, the price of silver goes up? They dump more shares. It's just continuous. It's like when the price of silver spiked in 2020, like every mining company pulled their skeletons out of the closet and listed them all on all the exchanges. and then they had secondaries and they just dumped tremendous amounts of shares. So you need to find the companies that have good management, that are focused on generating shareholder value, that have accretive economic projects where they don't have to continuously dilute. And in a mining company, you need to find those mining companies that make enough profit to sustain themselves, or else you're just going to get endless dilution. Like core mining, goddamn, when you say silver, people are like, oh yeah, core mining. They think of core first because of silver in the United States, but damn, that stock is trading at, I don't know, 3 or something right now. And split adjusted, they had all these reverse splits along the years. And in the 90s, it was trading at $300 per share. And it's now trading at 3. And it's run the same way. A lot of these companies are run for the benefit of bankers. Debt deals and secondaries, and the bankers get rich, management get rich, and shareholders get screwed. So you need to find the companies that are focused on shareholder value, that are profitable with high grade deposits. And regarding the portfolio thing, I'd look at the smaller section of this sector, and I've got some really high grade stuff that I'm really amped about, and I think those offer the biggest bang for your buck. But you really got to know what you're doing, right?
So yeah, so are precious metals stocks then, is it a stock picker's market? I mean, does indexing work with gold stocks? So the GDX and the GDXJ gonna capture the up move, or are you better off with one royalty?
Yeah, the GDX, the thing about gold stocks, yes, it's a stock picker's market, but the total market cap of the gold and silver sector is relatively small. And that GDX and the GDXJ are monsters within the industry. You're either in it or you're out of it, due to their specific criteria based on volume and stuff like that. So therefore, a lot of people prefer the GDX or GDXJ to invest, and it really pushes around the sector a lot. Companies that are going to be added, not because they found high grade deposits, not because they have great results, but because they finally met the criteria of volume, and and the stock will go up 20-30% when it's listed, and that's usually the peak for the next couple of years. So it's important to track, but I like a lot of the companies that are smaller, that are not including the GDXJ yet, or on the buffer of the GDX, that offers some opportunity.
Okay. So you mentioned then focusing on like the exploration and development companies. So is the Lassonde curve accurate? Is that something investors should understand and consider?
Yeah, I've seen charts on that. Like, I love Pierre is awesome. He's the best guy, legend in the industry. Lucky Pierre spent $2 million in Gold Strike, and he keeps getting lucky. He's awesome. And I'm very familiar with the Lassonde curve, where you get the exploration success, stock ramps up higher, and then that explorer doesn't have any money, so they got to dilute, and the share price trades down. They start, they raise the capital through selling shares or debt. So the dilution's over, they start moving to the production phase, and then it ramps up. And, in theory, yeah, like that is legit. I'm 100% on board. But in practice, I haven't seen it play out exactly that way. There's always some other factors going on. But in a very simplistic scale, yeah, it's important to follow.
Okay. So I guess one more about the general philosophy thing, because you cover a lot of companies. I do too, in countries that most investors listening to this might consider, uninvestable. They might think you're crazy for investing in Bolivia or Ecuador or Nicaragua, we'll talk about later. So how do you think about jurisdictional risk then in the portfolio?
Jurisdictional risk. But let me say one thing about portfolio management. Like 90% of your gains are driven by 5% of your stocks, right? And when you get winners, you ride them. So, in a smaller portfolio like the GP10X on the smaller guys, you're going to have a lot that are going to fail. They're going to go to zero, but you're going to have big hits. And then you let that continue growing to be a larger piece of your portfolio. And once those high grade hits start coming, they usually don't stop. They continue for years and years and years. So all you need, with the explorers, I would say you need about 10 of them. And a few are going to fail, and a few are going to go through the roof. And just hang on to your winners, and then it'll more than cover the losses of your losers. And then regarding jurisdiction risk, all the miners have significant risk. Like, you look at You look at Mexico, you look at MAG. I love MAG. I love the grade. I love Juanicipio. I love the operations. It's one of the best silver mines in the world. But they're a 40% owner with 56% owned by Fresnillo. And Fresnillo hasn't been very quick getting them the cash. So, what's stated on the balance sheet isn't necessarily, fact. And over time, it'll work out. You look at Escobal, that was run by Tahoe, that Pan American ended up acquiring. Escobal was the highest grade silver mine in the world in Guatemala. It was freaking amazing, generating huge profits for Tahoe. And then they blockaded it and shut it down. And even mines in the United States, have, tremendous risk. It might not necessarily be jurisdictional risk, although they're always talking about increasing taxes and stuff like that. But it's operational risk, and basically, I believe that every issue is basically about money. You know what I mean? Like bottom line, like either they're not paying the right people or giving them enough money, therefore they get shareholder protests. Company in Mexico that had the San Jose mine, a lot of protests and stuff like that. I don't know. Maybe they're not treating the locals right. Maybe they're not sharing enough of the profits with the locals. You look at Randgold, run by Mark Bristow, operating in some of the most brutal places in the world, like the DRC and stuff like that. He never had a problem. Why? Because he treated all people as stakeholders equally, and everyone got their fair share. So I think the miners that run into trouble, they're greedy and they're not taking care of all the people.
Do you think then some jurisdictions are mispriced? Like, are mining investors too comfortable with Canada and the U.S. and maybe they demand too big of a discount to be in Peru or?
Yeah, I haven't looked at the premium or discount on these miners, but you got to figure it's there. And then we mentioned Bolivia. Bolivia just had a little coup and it got stopped in like 10 minutes. And it disrupted the stock for a day. The next day it was fine. But like I said, I follow high grade resources wherever they are because if it's profitable enough, it's gonna be developed. And if it's run the right way, by treating everyone as stakeholders, they're not going to have any problems. And that includes the government. Bolivia tried to take over the mining industry through Comabol like 20 years ago, and it was a freaking disaster. Like governments, they can't run mines. They can run an oil well, right? Because you just got to stop straw on the ground and you're pulling out oil and filling barrels. Mining's different. Mining's tough. You got to know what you're doing geologically. You're running 24/7, 365. So what happened in Bolivia? All the mines went out of business, and all the good assets ended up owning. All the politicians ended up owning all the good assets that they run privately now.
Okay. Interesting.
Yeah.
So you visit some of these mines. I've seen you post like pictures of you going to some pretty far out destinations to visit mines. What do you learn when you go visit something that you can't pick up? Like, what is there a reason to be going to the rainforest in Nicaragua to see a mine?
Yeah. Well, first of all, you get to see the operation. One mine tour I went on, the CEO was like walking around the parking lot, like picking up nails. Like I think it was pretty much a show, you know what I mean? So to making sure the equipment wasn't going to run over it. But you look at the roads that are basically all dirt. You look at the operation. Like I went down to visit Mag, and it got built. The operation got built by Fresnillo. It looked like it was beautiful. It looked like a parking garage here in Florida. It was all smooth. It was beautiful. It's like, hey, this looks great. And other mines you go down, and you get an unsafe feeling. You're like, yeah, I don't know if I want to.
Interesting.
Where they're not spending capital for development. And then one of the other things, it's not necessarily minor related, is that, I'm in the United States, I'm in Florida, grew up in Boston. You listen to the local media or the national media, they're like, oh, Nicaragua, don't go there. It's too dangerous. Don't go to Bolivia. Don't go to Mexico. Don't go here. It's just fear, fear, fear. And then you go to these places and you walk around the center square and everyone's polite, everyone speaks English, everyone's respectful. You go to any park in the United States, the Northeast or wherever, and everyone's trying to freaking rob you, and you don't even understand what they're saying and they're rude. And so a lot of these countries are beautiful and they offer tremendous opportunity.
Yeah, I'm with you. I travel a bit with the fiance. And I got really comfortable with the Balkans by just being there, right? Like I own Dundee in the portfolio. And I didn't know anything about the Balkans, but after traveling around for a bit, I go, okay, this is actually a normal place. Like it's not nearly as risky as I would have thought it was before I went there.
Yeah, yeah, absolutely, no doubt.
Okay. So let's take a step back then. We talked about the golden portfolio, some portfolio management stuff, but let's talk about the macro a bit. And we're recording on August 6th. So yesterday was a wild day, the highest volatility day in markets and like the third highest since 2008, something like that. Everything was down, right? Limit down, circuit breakers, gold, silver also down. I think silver was 6% down. So what's your macro outlook for the precious metals, gold and silver?
It's to be honest with you, it's pretty simple. Like the yield curve, like there's many ways to look at it. I've been looking at it. The 2-year minus Fed funds rate. 2-year is, the market price, and it reflects how the economy is doing. And the Fed rate is managed by the Fed. So when the Fed rate is too high, and the 2-year is too low, it shows the 2 years expecting rates to fall. And the difference between the two is like 1.61% right now. It's an extremely negative yield curve. Every time this happens, it shows the economy is going into a recession and the stock market crashes. Like the timing's really hard, right? Like this has been the longest yield curve inversion of all time. It's been going on for like 2 years. And if you were short the market over those 2 years, you would have lost everything. But now it appears to be kicking in right here. And then the important thing to note is yield curve negative, market crashes, and the Fed comes in and they start cutting rates and they double their balance sheet. I was presenting in Zurich and they're like, when's the Fed going to cut rates? And, it's all, jobs report this and inflation this. It's like, no. The Fed cuts rates when they have to. The Fed cuts rates when the market goes down. Now we have the market finally going down. The Fed's going to cut. And then every time that they start cutting and the market sells off, they've doubled their balance sheet. And the Fed's balance sheet right now is, God, what is it? $8 trillion. Yeah, like $7-8 trillion. Back in 2000, it was like $500 billion. It's gone up exponentially. So, I expect the Fed to come in and boost up their balance sheet again, which is going to increase, debt and stuff like that. And then every time they boost up their balance sheet, the gold price doubles. It doubled in 2000, doubled in 2000, the years following 2008. It doubled in the years following 2019. It's going to double again. I don't necessarily love talking about the gold price because there's guys out there, they're all like, whatever, 10,000, 20,000, they don't know nothing. But, in this case, you get $2,500 an ounce gold basically right now. Based off of what's happened over the past 2 decades, like it's not out of reason for it to double. Like the gold price at $5,000, it's not a crazy thing to say, So yeah, I'm pretty comfortable saying gold's going to be at $5,000 in 3-4 years.
And what about silver? Is silver just levered gold, or is it its own market? Is the yield curve equally bullish for silver?
Yeah, I think silver follows gold. Silver's really volatile. And one thing regarding the silver industry is the margins are smaller than the gold miners because, a lot of the silver produced is concentrate. You produce Dory bars. It's basically 100% pure. They get no processing costs. The concentrates sales, you're only getting 80% back. There's a 20% hit. So the silver margins are about 20% lower than gold's. Gold's are about 55%. Silver is probably, I don't know, 30, 35%. It's just always low. But silver provides volatility. Like when gold starts moving higher, silver really starts ramping higher. Finally, the supply is getting out of whack. The silver survey, has been showing the deficit of 100 million ounces versus silver production of 800 million ounces per year for years. And then solar demand. Solar is going everywhere, and for solar panels, they use 20 grams of silver. That's like 2/3 of an ounce of silver, like every solar panel, and millions of megawatts, gigawatts going in all over the place. So I do think it's impacting the silver supply demand equation. It's increasing demand, and the supply, it's not increasing. And then silver supply, like I forget the exact number, but only 50% of it comes from the companies that you would think of, say like Pan American, which is basically a gold miner now, but Core, Hecla, First Majestic, all those primary silver companies, basically. The majority of silver production comes from copper mines. There's a mine, KGHM, Polska in Poland. It's huge base metal operation, and the average grade that they're mining copper, but they get like 2 or 3 grams a ton of silver in it. But just that volume, they're producing hundreds of millions of tens of millions of ounces of silver every year.
Yeah, one of the arguments I hear for the silver mining stocks is that there's just much fewer of them than the gold miners. So if you do start to see significant inflows into gold and silver miners, you would expect the silver miners to go up faster because there's less of them, more
Yeah,
money
no
into
doubt.
fewer names.
No doubt. Like if it gets wacky, like it did in the 80s, so silver's going to go through the roof, silver miners going to go through the roof, and yeah, there's few silver miners like for a reason because it's a hard biz. Like I follow a lot of silver miners very closely, and some of them, the average grade's about 250 grams a ton, and those guys are like break even. They are, bad trying to balance your checkbook every single quarter,
It's
shifting
tough.
$5 million here, $5 million here based off, the movements and the price of silver. It's hard, but the silver miners I like are, much higher grade, 500, 600 grams a ton. So they're more stable and they generate more profits. But yeah, if the money starts coming in, there's not many to choose from.
Okay. So help me understand one other macro concept that I have a hard time filtering through when I see posts, see a lot of content about on Twitter, but I see people talk about the Shanghai premium, the COMEX, ETFs are taking physical delivery and the COMEX is getting drained of gold and silver. I mean, what do I need to understand about this? What's real? What can you tell me? Because I don't know what to make of any of that.
I
I kind of just ignore it.
I track that stuff almost every day regarding the commitment of traders and physical delivery, and you do see spikes in physical delivery that happen when silver ran up the last time, and then inventory starts going down. And then a lot of people like to talk about it on Twitter and say, oh, they're running out of silver, blah blah blah. But what happens when the inventories run low? They come in with like another 800 million ounces, like every time.
From where? From where? Like, where do they find 800 million
Well,
ounces?
that's the thing. I don't know, to be honest with you. Starting to get into conspiracy theory, but the way the financial system is built, right? You get a silver ETF and a gold ETF, and it's run by a bank. And how does a bank make money? They make money by
Mm.
loaning stuff out. So it's like if you have this gold and silver sitting in a vault, like that's not going anywhere. Why wouldn't you loan it out, to make money? And whether you loan it out one time or 100 times, like the people don't know. Like a bank, if they get $1 million in deposits, how much do they loan? Like $100 million loans, right? They don't just loan out a million deposit. It's leverage. They don't loan out 100 million. And I don't know, the same thing might be happening in the gold and silver industry. You get 100 million ounces of silver sitting in a vault, you loan it out 100 times, make a little bit of money off each one.
Wait,
So, naturally it makes sense. I have no evidence, I have no proof. It's interesting to think about. But I'm a fundamental analyst like you, and I'm just going through the 10 Qs and trying to find the most profitable miners because you can whine about the conspiracy and the price suppression for years, but I who knows when it's going to change, if it's ever going to change. I don't know. I think it'll change. I think it'll change once inflation really starts picking up again. The Fed doubles their balance sheet. A bottle of Coke's going to cost $25. People are going to be worried about protecting their savings. And yeah, gold and silver are going to do very well. And then, all this government spending, it's not slowing down, it's increasing, and the public debt's a crazy astronomical figure. And, you're like, oh, in the long term, this is going to matter. And you're like, yeah, don't worry about it. The debt, it doesn't matter right now. But you know what? I don't know. Maybe we are close to the long term here, maybe it is a good
I
time. So,
I
right.
I tend to agree with you. I think the long term is starting to arrive, right? The baby boomers are now pretty much fully retired. So all those
Yeah.
pension assumptions and Medicare benefits that they owe out are coming
Yeah.
due, right? It's not
Yeah.
5 years out anymore. They're all retired. So they got to pay
Right.
for it now.
Yeah. Nothing adds up.
No, especially if you look at any of these big corporate pensions that
Yeah.
just the 8% return and there's a huge gap and I don't know what they're going to sell and where that money's going to come from over the next 5 years, but we'll see. So let's talk then maybe about some of the more specific names. Talk about Nicaragua, the first one I wanted to ask you about. I think it's one of the more interesting stories I follow in Latin America, right? It's Nicaragua's largest gold miner, Calibre
Yeah.
Mining. I own it. I've owned it for a few years. I also owned Marathon. I bought the top of Marathon, so I got more Calibre shares after the acquisition that I've held. I've never sold any. So what can you tell me about Calibre just in general? Bullish, bearish,
Yeah.
like the company,
Well,
like the assets. Have you been there? I think you posted
yeah,
pictures
I
that
was
you.
there. I went down to Nicaragua, El Limon and Libertad. And what the deal is, I've been covering the company for a long time here. And the guys that started the company, Blaine and Doug Forrester and Blaine McAllister or something. But those guys, they found a new market gold. Do you know New Market?
I've heard the name, but that's well before I was.
So
I was.
new market, right? These guys are private equity guys. They want to make money. Like they're not mining dudes. They're not like
Mm,
mining CEOs where they're spending billions to increase production, and they're not making any more profits. These guys are spending 100 mil. They want to get 200 mil back. So they had some money and they were looking around and they found a company that owned Cosmos and Fosterville in Australia. Oh, Crocodile Gold. And they bought it up for, I don't know, 50 mil, 100 mil. And then they started, producing. And the thing that attracted me to Newmarket was the free cash flow. It was a high grade resource,
mm,
generate tremendous amounts of cash. The stock only traded for 60, 70 million market cap. They're generating, I don't know, 20 mil free cash, 30, 40 mil free cash flow a year. I'm like, this is a tremendous opportunity. And one thing regarding that is good things happen to mines with high grade resource because they generate profits. Profits are used to, buy back shares, pay dividends, and also make smart acquisitions. So, I looked at the value. I'm like, I got to get involved. I'm like, I don't know much about it, but you got to get involved. So then they started drilling more at Fosterville and they started hitting crazy high grade stuff at Fosterville. And you know Fosterville, right?
in Nevada, right?
No, Fosterville is in Australia. Yeah.
Ah, okay,
And,
yes.
yeah. And then the results kept coming. And then Newmarket got bought out by Kirkland. I think it was Kirkland. Yeah, I think it was Kirkland Lake. And then they found the Swan deposit. The Swan deposit was, I don't know, a few million ounces of like 30 grams a ton. And then what was it? Agnico came in, I believe, and bought out Kirkland. But if you look at the progression of value creation, it was like 40,000% from owning Newmarket shares. It
That's
was crazy.
yeah.
So then they made all that money, and then they started looking again. These guys, Blaine and Doug, and they found Elimon and Libertad that were run by B2 Gold. And B2 Gold has been focusing on West Africa. They had these two little assets in Nicaragua. They weren't paying attention to them. They were running the Elimon mill at like 30%, filling it with waste. It was an unprofitable production. And then they got a great operational guy in there who really knew what he was doing. He was going to increase grade and boost profits, and they've done it. They're very profitable at their Eldemon. They turn them around. They're turnaround specialists. And then they found opportunity in Valentine up in Newfoundland, and that looks pretty good. Although they've had to sell shares a little bit, but that's part of the biz. That's what happens. But it looks to be an extremely accretive deposit. But like one of the main things you can take away from that is you got to find the people. Like, right,
Yeah.
they're all closely affiliated in Toronto and Vancouver. You get these C-suites that are basically taking care of each other, buying shitty assets from each other just because one of the other companies is in trouble, giving them sweetheart deals. But Blaine and Doug, they're focused on making money for themselves and making money for shareholders. So yeah, Calibre is a great run company.
Yeah, it's been so interesting to see a Nicaraguan company reinvest their profits to buy a Canadian company, which most investors would think that's kind of inverted, right? Nicaragua is the high risk one, but they're
Yeah,
producing the cash flows to go in and buy the tier one asset.
yeah, Yeah, and then Nicaragua, I was like, oh, I've been down there. It's beautiful. It's very nice, and it's an extremely profitable mine. And as long as they're paying the right people, then everything's going to be all right. A lot of these Latin American leaders, they will say stuff to the people to get the votes, right? And then in a closed door session with the companies, it's all about money,
Yep,
you
yep,
know. So,
exactly.
we're anti-mining. We're going to shut down the mines. We're going to take them over, protect our regions. Like, no, they're not. No, because they know they can't generate the profits. Then it's a lot of work and effort for them too, right? They're better off, just collecting checks, from a partnership with a
Yep.
mining company. So, and like I said, I follow grade, and if I find a interest in high grade story, the jurisdiction doesn't necessarily scare me off.
So what do you make then of their hub and spoke model? Because that's not the most common model I see the mining stock. So is that a function of the infrastructure in Nicaragua? Is that
Yeah, it's
strategic?
because yeah, no, it's because Libertad runs like I don't know, 8,000 tons a day. They're only filling it with like 2,000 tons a day. They found some high grade ore from across the country from projects that they own. So, they calculated the cost of trucking it across the roads to fill the mill. It makes sense. It's economic. That's why they're doing it. It's not
Yeah.
just a boost production. Because like a mill, like I talked about before, it's fixed costs. A mill has
Yeah.
fixed costs, whether you run at 2,000 tons a day or 8,000 tons a day. The costs really don't change. So the more ore that you fill it with, the more your profits will lever up. So, that's the reason they did it.
So does that give them more optionality on future discoveries? I mean, they're the only real miner I know of that's producing profitably in Nicaragua. So it would stand to reason if there's
Yeah,
ever another mine built, they're first in line. So
right.
is there still exploration potential? Like, can they plug in another mine to the hub and spoke without any issues?
Yeah. Well, they got like six other properties in Nicaragua,
Yeah.
and they're exploring a little bit on each one, and they have some interesting high grade results. So yeah,
There. So are there any royalties or streams? I don't remember. I don't think so. I know
not that I
B2
know.
BTG
Yeah,
still owns like 20-25%, but I don't think any.
yeah. They sold some of the shares recently. Not a big deal. That deal happened probably I don't know almost a decade ago. But yeah, I don't know. They might have a stream or two. I don't know.
Okay. So yeah, let's talk about Valentine and Marathon then, because I mentioned I owned Marathon when it got acquired, the Valentine project. So what do you make of the region, right? Because I think I hear a lot of investors talk about, this being a new emerging gold region in Canada. Is it more hype, or is there really a lot of exploration potential?
I don't know. You get newfound gold up there.
Yeah.
That stock went through the roof, all the high grade results, but they're having trouble bringing it to the next stage, a development stage, and proving out their resource. The grade is there, no doubt, but operationally, it hasn't really been proved out yet. I trust Calibre and I trust the guys there that
Mm.
they know what they're doing, and they wouldn't have got involved unless they were pretty sure of this. And then, I run, my numbers on Valentine, and, it's going to do 200, $300 million of free cash flow a year. It's huge for, 483 mil capex. And that's the stuff you need to look at. Like I said, a lot of mines, they'll buy a company for a bill, they'll spend 500 mil to build, they never get their money back. But, this one, they're going to get their money back in like a year, hopefully, if everything goes well. So, the private equity guys, Blaine and Doug, they're smart. That's how they, look at stuff. And, if you look hard enough, there's opportunities out there.
Yeah, we went back and forth. I commented on a post you made on Twitter, and you explained to me that this is how the game's played, that Marathon had huge cost overruns, or at least that's what was speculated, building
Yeah.
the mine, and they
Yeah.
had difficulty continuing to finance it, so Caliber came in and bought them at what appears to be a pretty attractive price.
Yeah. That's what it looks at. And capex did blow out a little bit, but all capex is blowing out everywhere due to cost inflation, affecting the industry for steel and raw materials and gas and diesel and all that stuff. So yeah, in the end, they spent 483 mil capex for it, and still at that number, it's extremely accretive project.
Yeah. So then They did have to go in though and issue 100 million, I forget if it was Canadian or US, in new shares after the acquisition. So help me understand how you think about that, because I 100% agree with what you talk about with dilution being the biggest problem. I've been diluted on some of the names I own, and it's terrible. It's brutal. So how do you differentiate them between good dilution and bad dilution in mining stocks?
You got to look at what they're going to, how they're spending the money, right? Like if they're raising 100 mil, what are you going to do with it? Are you going to
Build
use
a
it to
mine.
build a mine? And then you can do your economic analysis and go, oh, shit, you're going to get $1 billion back and you're only spending, 400 mil, here you go. Here's my money. That makes sense to me. But just the unnecessary dilution,
Diluting to go, so diluting to go drill in a cow pasture is bad. Diluting to
yeah,
complete a mine that's already 40% built that's going to generate free cash flow in 12 months. Okay.
yeah, exactly. You got to see where it's going.
Okay. So what do you think then in general for M&A? I mean, is Calibre going to be an acquisition target for a major if we start to get a sustained bull market in gold, or are they going to be the acquirer? Or do you think you see these mid tiers come in and start to keep acquiring projects like they did with Marathon, or do they get taken out by a Newmont or a Barrick?
I don't know. I almost see it like a family sort of operation, not in a bad way, but in a good way, because it's like owner operated, and they care about profits, and it's not run like a major where the majors are like doubling and tripling, growing gold production from 500,000 ounces to 2 million ounces, but profits per share decrease over that time. It's like that. It's insanity where, these guys, the large companies, they increase production, they get bonuses, and the share price goes down over that time. These guys are interested in putting money in the bank, and I think Calibre is going to fill their plate over the next few years. I don't see them necessarily being an acquirer unless something really tasty and low cost, fell into their lap. But potentially if Valentine proves out to be a tremendous opportunity and resource and mine, it could represent a takeout opportunity.
Interesting. Okay, so there were a couple other countries we talked about that you said you follow projects in Latin America. We mentioned Brazil and Guyana. This was before we got on. So are there any other projects or names we can talk about in those
Yeah,
countries?
I'm starting to get into Brazil. I'm starting to get in Guyana is amazing. It's like it's like the Western Shield, right? Like it is the
It's
whole. If you take, South America, it fits right into Africa. And there's one mine called Awali Resources. They're coming out with crazy hits in CDI of like 30 grams a ton over like 80 meters. It's insane. But then if you bring the continents together, like it fits right into that Guyana region. And Guyana's been hot recently. G Mining, run by the Gignac family, are tremendous operators. They built some of the best mines in the world. One at Navanu and Marion. And these guys generate tremendous shareholder returns. And they built out the Tocantinzinho mine in Brazil right now. That is in production this year. And G Mining just went in and they bought. I'm covering 60 different companies. They just bought Reunion Gold, and Reunion Gold has an amazing property in Guyana. High grade, 4 million ounce resource of like 2.2 grams a ton, and they see the Reunion deposit represented tremendous value, and like one of the lines is they're focused on profitable ounces, economic ounces. Like all ounces are not created equally, right? Like there's good ounces and bad ounces. You need to find those good ounces where it only costs a couple $100 million to build, and your NAV is $1 billion. All those are that builds shareholder value. So you have that acquisition. You get G2 Goldfields over there, that owns Oko, and they've been building Oko out, and Oko's even higher grade than Reunion, and I think Reunion owns Oko West, and they're basically connected. And then there's another company, Founders Metals, that's got Antino, that's at like 2 grams a ton, and they're drilling and just piling on the ounces. And I could see some consolidation within that area. regarding G2 and Reunion and G mining. And it's, saprolite ore. The recoveries are very high. It's relatively easy to mine, except for all the rainfall. A lot of the mines there have done very well.
Yeah, the Guyana story's been fascinating because the oil market too. I mean, there's a ton of offshore oil in the equatorial margin that, I mean, I think Venezuela threatened to invade and they were just going to take over Guyana pretty much to get the oil because I think it's one of the biggest deposits in the world. So it's been really interesting to see that get news coverage and continued exploration.
Yeah, yeah, no doubt. And Guyana seems to run the mines well. They have their profits and their royalties that the government gets, and the miners are free to do their jobs, without a lot of red tape and bureaucracy.
Yeah, I think if you want to go mine in Guyana, they'll let you do it because I don't think they have many people lining up to go move to.
And then, yeah, the other thing too is like these smaller countries, they don't have a lot of jobs down there. Like Nicaragua, they got like a Chinese auto plant and they make t-shirts and stuff like that. There's no jobs down there. These mines represent tremendous opportunity, for the people. The Cobre Panama mine employed thousands. It was the largest piece of GDP for Panama.
That was what was crazy about that story, right? Because I
Yeah.
agree with you. You wouldn't expect you say, okay, if it's a huge part of GDP and employs 2% of the workforce, like of course they'll leave it alone. Maybe they'll posture politically, but they actually shut it down. Like they just
That's what I'm the same boat as you. That's what I thought too. I'm like, there's no way they're going to do it, but they ended up. I don't know. They did it.
yeah. I
They
had a
never.
Panamanian guest on that works with me ranks too, and he said just to keep it in care and maintenance too, they spend money. So it's not like they didn't just shut it down. He said they're probably still spending 50 to 100 million a year for
Yeah,
security and to keep it closed, which is just
yeah,
absurd.
yeah, it's crazy. And then Brazil's been popping up. Tocantino just started production out there, owned by G Mining, and then one company, Lavris Gold. Lavris Gold owns a large property over there, and they just started drilling a couple years ago, and they've got like 7 or 8 different targets, and they got great results of highly prospective and high grade ore. And it just keeps building, and it's like the caldera of a volcano with all the veins and offshoots, and they're just trying to get their mind around it geologically. But it looks interesting.
Interesting. So I could ask you 100 more questions. There's full countries we didn't even cover yet, but I want to be respectful of your time. So we'll have to do this again in a few months, and maybe I'll ask you about, I don't know, some Peruvian and Ecuadorian names the next time, and we'll fill an hour, no problem. But
Yeah, definitely.
thanks so much for doing this, and
Oh,
and
yeah. Well,
tell
hey,
listeners where they can find you, where they can learn about the golden portfolio.
yeah, yeah, yeah. Do you know Fruta del Norte?
So is it London?
Know about
Is that
Lundin,
Lundin? Yeah, yeah,
Lundin Mining?
yeah.
That thing is a beast. That thing's like 9 grams a ton, average grade, and like their economics are through the roof, and it generates tremendous amounts of free cash flow. And then you look at Lundin, they're generating so much money. They're paying out dividends, they're buying back shares. I do not have that in my portfolio because it's too large cap, but that's the sort of operation you need to look for. You need to look for high grade, you need to look for profitability. Good things happen when you own high grade, profitable projects. But so Garrett Goggin, www.goldenportfolio.com. You can find me on Twitter at Garrett Goggin. Yeah, sign up for the GP for the Golden Portfolio, sign up for the GP 10X for the smaller explorers and developers. Some really amazing high grade stuff that I'm really excited about. And then you can join our pro and get both of them. So.
All right, and that's all linked in the show notes for anyone listening if they want to just click it easy. Thanks, Garrett. This was fun. I appreciate
All
it.
right. Thanks, Patrick.